Today we will talk about chapter 18, and this is the first chapter of managerial accounting, and the rest of the course will be covering managerial accounting. So we've been covering financial accounting, and now we're going to move on to managerial accounting. This is an introductory chapter, so it's going to have a lot of broad information about managerial accounting. So first, we want to define managerial accounting and understand how it's used. Remember, you learned about financial accounting in Accounting 1 and the beginning of Accounting 2, and that really focuses on providing information for external decision makers. That is, people that do not work inside the company. So stockholders, creditors, which are banks on somebody that loans money to businesses, anybody outside the company would be external. Now that we're talking about managerial accounting, we're going to focus on internal decision making. So we don't have many rules. We don't have to comply with GAAP. Everything that we do is what management needs to know to make the decisions for the company. Okay, so here is the definition, but it's going to be information designed to meet specific needs of a company's management, and it's going to provide different types of information that's going to help us make decisions in daily operations, future operations, and business strategies. This is a table that will help you to distinguish between financial and managerial accounting. So we just talked about what the primary uses are. For financial accounting, it's external. Okay, for managerial, it's the people inside the company, internal. And we already talked about the purpose. For financial accounting, we're looking at lots of different things as far as we're looking at the financial statements to make decisions, such as do we want to buy the stock or do we want to lend the money. We're really looking at more objective information. Okay, so for financial accounting, the focus of the time, we're basically looking at the past. You have to know what the close of the financial period was and then prepare your reports. But managerial, it can be based on the past, but it's also relevant, and it even focuses on the future. So people will prepare budgets, which is an estimate of what's going to happen in the future. That's not going to be something you see in financial accounting, but because it has to be things that have already happened so that it can be properly estimated and recorded. But in managerial accounting, we need to budget for the future in order to help us make decisions. So one thing that I like to point out is managerial accounting, it can be the past, the present, and the future. The rules and restrictions are very strict for financial accounting because we are protecting external users, so they have to follow GAAP. But for managerial accounting, people that are going to be using the reports work inside the company, so they don't have to follow GAAP. It can be anything, and the report can be ran any way that's going to help the managers. So the scope of information for financial accounting is more summary, and it can be summary for managerial, but they may also ask for more detailed reports, maybe even what did sales look like for one particular store. Okay, so that's why it could be for the company as a whole, or it could be for a segment. It could be for one district or for one state. So it could be very detailed reports, and sometimes even on a daily or weekly basis. For financial accounting, they're going to have a concern about, did we disclose everything we need to? And for managerial, they're just going to be concerned about how the reports will affect employee behavior. So one is protecting outside people, external users, and then one is is looking at or concerned with internal users, such as your management or your employees. So here are your external users of your financial statements. So we're talking about financial accounting here. Okay, and then this goes back to the managerial accounting and how it focuses on management. Here are some of those differences that we talked about. Okay, prepared according to GAAP for financial reporting, but for managerial it's not really relevant. So you can read over this slide since we've already discussed that. Okay, now let's look at the management accountant in the organization. So what is a manager's role in an organization? Many of you may have been a manager for a company. If you have, you know that you play a major role in probably the day-to-day operations, or depending on what company you work for or what type of manager you were, many of you may have a more strategic role in that company. So it's very broad, and it's based on what level of management each person is in. You can look at an organizational chart or organization chart to help you understand how the company's set up. So this is an example of an organization chart for Callaway Gold Company. So at the top, you've got the president and the CEO. You could also have, even above that, the board of directors. Okay, because they're usually at the very top. But here it's the president and the CEO. Under that, you have some vice presidents. You have a chief administrative officer. Okay, under that, the vice president of human resources. And you can see the different types. But over here, you see the chief financial officer. This person will be in charge of the finances, and it will be in charge of the COO, the chief operating officer, or the controller down here. Okay. So this is an organization chart. Okay. So under the CFO, you may have a controller. Here we have a controller or a treasurer up under that, and maybe even a payroll processing manager. If it's a small company, the CFO may do everything. If it's a large company, you may have even more breakdowns. And then if you have a chief operating officer, you may have a company, you may have different types of managers. Here we have a plant manager. You may also have a sales manager. So what this organization chart does is it shows you who reports to who and how it's organized. So if you ever have an issue and you need to know who you need to see about it or who to report to, look for the organization chart. So even though the board of directors wasn't mentioned, I want to mention we talked about the board of directors, and it's usually at the very top if it's a corporation. And remember, the board of directors is elected by the stockholders. So you remember how we say that if you own stock in the company, you have the right to elect the board of directors. That's what the board of directors would do. So the stockholders elect the board of directors. And your president and CEO has the ultimate responsibility for implementing the company's short and long-term plans. Okay, so each position here can be classified as either a line position or a staff position. So a line position would be, for example, a sales manager, and a staff position would be human resources. So if they're directly involved in providing the good or service for the company, they are a line department or a line position. So here's some examples of some line positions. Because look at them. This is equipment. This is managing the plant. This is the vice president of the brand. And then the managing director. So a staff department is going to provide service assistant and advice to the departments with line or other staff responsibilities. So your staff's going to be like your human resources, your chief financial officer, controller, your senior vice president. These would be staff positions. They're not directly involved in producing or providing the service. So the controller is your chief management accountant, and the controller consists of a variety of other accountants who are going to be responsible for specialized accounting functions. So here are some of those: taxes, reports, budgets, cost accounting. So the management process is going to be broken down into 5 phases. So planning, directing, controlling, improving, and decision making. We're going to break planning down into 2 types. You have strategic, which is long-term goals, and operational, which focuses on the short-term actions of the day-to-day operation. So managers direct, which means they run the day-to-day operations of the business. So an example would be the production supervisor's efforts to keep the production line moving without interruption. That's an example of how a production supervisor would direct. Another example is when a credit manager develops guidelines for assessing the ability of potential customers to pay their bills. They are involved in directing. Okay. Controlling. Managers control, which is the process of monitoring day-to-day operations and keeping the company on track. So you want to remember that control means more of monitoring and then comparing. So the feedback is going to allow management to isolate areas that need to be investigated. So we're trying to keep the company on track here. And so the philosophy of controlling by comparing actual and expected results is called management by exception. So remember we talked about in the previous chapter how, numbers are no good if you can't compare them. Well, same thing here. Management's going to compare actual results to what they expected, and they're going to manage. They're going to use the feedback to improve operations.